Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. So today I have with me Chris Salerno with QC Capital. How you doing, Chris?
I'm doing amazing, Lance. I hope you are well. Thank you so much for having me.
Yeah, no, pleasure's all mine. I met Chris, it's probably been 8 months ago now, sort of during the whole COVID thing. We connected through another guy, kind of a mutual acquaintance. And, I think he's got an interesting story. So he's sort of based in, the Carolinas and has been in, multifamily syndicator and his firm's been growing really, really good over the last few years. And so, got a unique story. And so I thought we'd bring Chris on to sort of share some of his, how he's kind of gone from, point A to point B to point C and on his way to higher levels, and sort of pick his brain on, what he and his team are doing to, mitigate that risk as they're out there, looking for high quality assets to acquire and, reposition and drive value. So why don't you share a little bit with us, Chris, how you kind of got into real estate to begin with, and, and sort of what the origin story for QC Capital was?
Yeah. So, thanks for having me again, and very excited to add value to everybody. So I got into real estate. I grew up in it. My father's been a broker in the state of Florida for going on over 40 years now. He's an old gentleman, and I'm an old soul. But I saw the light of real estate at a very young age. But about 6 years ago, I got into the single family residential industry and became the top broker here in Charlotte. I ended up creating a company and merging that with the number one company for Keller Williams at the time. And when I did that merger, I was always intrigued with businesses. How are they, or why are they failing? Why are they merging? Why did they purchase another company for that price? The ins and outs on it. Mm-hmm. And I found so many holes and cracks within this company. And I voluntarily said, hey, I love to do this, and let me dig my head in your P&L and help you out. At first, the owner was standoffish, but he finally opened it up to me. And I was able to make them 46% profitable in 1 year compared to a year and a half compared to their 3 years of being stagnant with no growth, by changing a lot of things. And from there, I just felt like I hit a ceiling. And I went back to a game we played when we were younger called Monopoly. And I realized you had to own the real estate to build wealth and to grow a large company. And that's where my mind was at. So I educated myself on the 08, 09, 2010 market and realized that multifamily was the strongest asset class. Mm-hmm. It recovered the fastest. You can't create an Amazon, a Alibaba, whatever. You can't create a company to take away shelter. Yeah, it's a necessity. We always need it. Mm-hmm. So that's when I dove in deeper to the multifamily industry to educate myself on it, and connected with coaches and mentors throughout that process, and was able to create QC Capital, which QC actually stands for Queen City, because we're headquarters here in Charlotte, North Carolina, and that's the nickname of Charlotte, is the Queen City. Back in, I believe it was 1884, the Britain Queen came over here, and that's how it was named, the Queen City. So that's what QC stands for, and then scaled the company very quickly. We have a asset right now giving me a headache, but we'll get through with it. Closes next week, and that right there will put us a little over 50 million and 500 units within 2 years. So, yeah, no, that's great. So for you guys, which obviously I know Charlotte's been a really great market, strong market. Oh yeah. Highly sought after. But are there sort of other markets that you and your acquisition team are paying close attention to and have sort of circled and are targeting? Or Yeah, I believe, as operators and as syndicators and if you're running a fund, but I believe you should have boots on the ground, because I know this market very well. I shop at the grocery stores. I eat out within the city. So I know the market very well. I know what's happening, the transition, everything. So it helps with us being local here in Charlotte, it's great because Charlotte sits in the middle of the Carolinas. So we do focus on Raleigh, North Carolina, Greensboro, Winston-Salem area, Greenville, South Carolina, and we will look into Charleston, South Carolina as well. So those are our major markets that we like to focus on throughout the Carolinas. And the good thing with being in Charlotte is that we're in the middle. So it's only a couple-hour drive to each city to really, take a look at a property, analyze it, meet with clients, things like that.
And so are you guys mainly looking at sort of Class C, taking a Class B? Like what's your, what sort of your box look like in terms of the, what are you out searching for, and what would make a good deal? Like for you guys, has it got to be 100 units plus? Has it got to be, what's sort of that thumbnail sketch of what you guys are looking for?
Yeah. So prior to COVID, we looked into Class C, but we really shied away from that. And come to the new year, our main focus is 1990 to 2010 type of product, over 100 units. Reason being is from our research and our analysis of these markets, if you have anywhere from 1990 to 2010 type of vintage asset, you tend to have a very strong tenant base in there that has very strong employment. And we're seeing that through COVID with the previous assets that we have ownership of, is that we're seeing that between that age, we have very strong tenants, very strong employers that are still employing our tenants, and they're paying rent, which is great. I think Class C type of properties are very struggling because that's more of your service workers. So they're looking for more assistance to pay rent. Your Class A, who's paying, $3,000, $4,000, and $5,000+ a month, they're gonna, realize, why am I spending all this money? COVID, they may get a pay decrease, they may get, furloughed. So they're gonna come down to that B type of product between 1990 and 2010. So right now, going into 2021, that is our main focus, is sourcing off-market deals with local brokers that we have relationships with in that category.
Yeah. So for you guys, when you go in and you find an asset, how much value add are you like, or, in terms of like how much per door are you putting in, or what does your typical sort of repositioning strategy look like?
Yeah, we used to put, with the previous assets, we have anywhere from $9,000 to $15,000 per door. But now our main focus is the newer type of product. So anywhere from $2,000 to $6,000 per door. And really, we'd like to stay under that $5,000 per door for value add. And that's, LED light fixtures, maybe a Nest system, make the unit go smart. Having it being a smart unit with a keyless entry app to the door. Things like that, maybe painting the cabinets, if putting granite in, but nothing very large where we're going in, we're ripping everything out down to the studs and we're changing it all. Because we found that, although that's very good, but you do have a higher risk when you do that. And you do come across a lot more challenges. And based off of the time to turn those type of units and the money you're putting in, and then the rent bump increase that you're going to get, it has to be substantial to make sense. And right now in the Carolinas, we're seeing a lot of deals that are other groups are just overpaying, in my opinion, and its cap rates are compressing. I heard of a deal that we didn't get because we're focused on this one, but the seller of this deal that's selling us this deal has another deal under contract in that same city, and he's under contract for about a 3.9 cap. Which I'm like, wow, holy cow.
Yeah.
A 3.9. Wow. It definitely, that's shocking for where that property is located. But we're seeing it compress because a lot of people are just wanting to park their money in multifamily.
Yeah, no, there's no doubt about it. Yeah. You're seeing a lot of that, and that's just it. It's just maintaining the discipline, right? To sort of know what it is that you guys like, and, what you can do. And it sounds to me like for you guys, a big part of it is having really good relationships with brokers, because brokers are always correct me if I'm wrong, but sort of navigating to certainty. They want to deal with, buyers who can close and get the deal done. And so you think that your roots is sort of being in that as what's allowed you to kind of get that head start on building that network and those relationships with the brokers, or?
Yeah, well said. Yeah, very much so. I think with being a former broker, even though I was in residential, I think that helps tremendously because most brokers want to get into the ownership side and to own their own real estate and want and possibly create a company. Most don't want to stay in the brokerage industry for the rest of their lives or their career. So it definitely helps a lot tremendously. But I've noticed also you need to know how the broker is compensated, because we all think the broker's compensated on that per deal. Well, there's a local group, or there's a very large group here in the Carolinas where they're not compensated on one per deal. They're compensated on the whole southeast of the region with that company. So that means if you are in Atlanta, Georgia, and you sell a property, your commission goes into a bucket. And in that bucket, everyone shares it. I don't know how, but everyone shares it at a certain period of time and things like that. So those brokers tend to not be motivated to help you out and help get that one deal closed compared to a broker that's relying on that commission.
Yeah, that's interesting. Yeah, definitely. You got to know the motivations of the parties involved.
Oh yeah.
How do you guys handle property management? Do you have your own property management arm, or do you work with sort of a single group, or how do you guys handle that?
Yeah, so we have multiple different property managers that we have had very strong relationships with. The reason why we like to send out our deals to multiple property managers is because they see that deal at a different angle, and we may miss something. We're not all perfect, and we all try to check all of our boxes, but you never know. And so we like to send it out minimum to 3 of our trusted property manager sources to see if we missed anything and see where they're seeing the deal from their perspective. But we will be integrating an in-house property management when the time is right. I just know that that's not a business I would want to be in. It's not a fun business, but we will integrate that in-house so we can have more control over the asset and ultimately investors can get higher returns.
So for you guys, in terms of the, whether it's through underwriting or whether it's through, asset management, what are some of those key things that you guys do that, to sort of, mitigate these risks or to, increase like you said, you're not going crazy and just tearing units apart and stuff, which of course,
Correct.
It definitely, that's requires lots of execution and obviously risk comes along with it. But, or do you have, a couple things that you guys do that you feel like really do sort of drive value, whether it's at the, creating a sense of community? You sort of mentioned some technology things that you've done, what are sort of those handful of things that are near and dear to your heart that you just feel like I got to do this when we get control of an asset, or maybe through underwriting that are deal breakers that you just, once a certain thing pops up, you're like, we're walking.
Yeah, so my underwriter is very Excel savvy, and he's created crazy formulas that will, if it hits something that doesn't meet our criteria, a red flag goes off on the whole Excel spreadsheet, and it notifies us where to look to make that change if it needs to be manually made or to address that issue. So when it comes to, adding other things and the de-risking the property, during COVID, we're underwriting at a 0% rent growth the first year and only a 2% the second year. When we get our expenses back from our property managers, we are always adding anywhere from 10 to 20% on top of that, just to be on the conservative side going into it. And we're really watching bad debt. We've also found, underwriting during COVID, a lot of sellers are really changing that bad debt and just tweaking it to where it's actually not actual bad debt. So we found that we really need to dive deeper into the collections and what they're collecting instead of looking at that bad debt line. Because a lot of them, from what we've analyzed, they're really not reporting that someone's not paying or anything on bad debt. So it's important to watch that. And that's one thing that we watch heavily. And so those are a couple things, some things to add tremendous value. We have a partnership with a company that we are able to own the Wi-Fi basically, where we would charge, or they charge us $15 per unit that is occupied. And then we recharge the tenant anywhere from $60 to $90, depending on how fast they want their Wi-Fi services to be. We charge them anywhere from $60 to $90, and we get the difference. So that right there adds tremendous value to our properties, just right off the bat.
Oh, interesting. Yeah. So you'll go in, take over a property. They probably don't have that amenity.
Correct.
And then you guys have sort of gone in and partnered and, drop in the gear and, hey, good news, we've got a new service, and basically they can kick Comcast or, or whoever, Spectrum or whoever the incumbent is to the curb and save a few bucks and add it to
the key is when you're analyzing the property, you always have to ask, when we're doing this, we ask, is there a contract with another local provider? Because if they say yes, then you now need to find out, is that contract breakable? How long is that contract? When does it expire? Because if they have a contract, we can't use that service, which that service adds tremendous value to the overall NOI of the property and the evaluation of the property. So we really like to make sure we can add that service to our properties, because it's this, everyone uses Wi-Fi. Now more people working from home, they're using it even more now. So our chances of having a higher user rate for that type of service is going to be larger, which is just going to make sure that the investors get a larger check and larger cash flow throughout the hold period.
Yeah. So for you as sort of, owner operator, what is the thing that makes you most nervous about a deal? Like what's the thing that keeps you up at night, especially after you've maybe acquired a deal like this deal you guys are trying to wrestle to the ground right now? What is that area for you that you focus in on the most, that you're sort of borderline neurotic about, that you feel like it's just got to be watched, that maybe others are sort of like, calm down, chill out, it's not that big of a deal? Do you have anything like that?
I would say when it comes to like underwriting, some of these groups are underwriting with crazy exit caps, which, when you mess with the exit cap, it messes with the IRR, which now you're portraying to investors that they're getting a higher IRR. And when I see stuff like that, I'm just like, you guys are crazy. There's no way you're going to exit I saw one deal, their exit cap was their entry cap. And it was like, that's just crazy aggressive. And, thinking you're going to get a tremendous amount of rent growth during COVID as well, underwriting for that is in my mind crazy. Because right now, and it is all market specific, but right now, it's very rarely you're going to get a 3 to 6% increase on a rental. During COVID right now, where everybody is offering, more concessions and things like that. So, we see our competitors do that, and we just let them do that. And we watch them very closely, though. I'm on a lot of distribution. So I make sure our underwriter analyzes their deals and underwrites their deals to see how they're underwriting differently than us, and it's important because, for example, the company that we have partnership with, if they have a different type of partnership with a different type of company, and I'm seeing that, they're projecting this, and I want to find out. I want to find out how they're projecting that, because they're our competitors. They're going to beat us out on any deal if that's, a legitimate reason. So.
Right. Yeah. So, but it sounds like in most cases, you guys and your team are sort of looking at what others are doing and sort of like, okay, you guys are just being, like you said, overly aggressive.
Correct.
Which I suppose does make it hard. I mean, it seems like, from spending a lot of time with guys like you, I mean, it does seem like that's one of the big frustrations. It's just, you're out there, obviously, raising equity capital is one of the harder things to do. But when you've got other people that are just, getting all creative with their pro formas to make it look like, they're going to be generating these crazy returns. Do you find yourselves having to sort of, answer questions like that with investors, or like, to where, I mean, because for those who are being more conservative, you're not underwriting any rent growth, and, and you're not, the exit caps aren't, ridiculous. I mean, you're coming up with a different result. I'm assuming in most cases, that means that your deals are, if they're underwrote conservatively, or 12 IRR, 13 or whatever. And if the guy next door is saying I can get 18, 19, 20, 21, 22, how do you guys deal with that?
Yeah, and then there's a deal we lost out on. We're going in at 14.4 million, and the other party was at 15 million. And the principal won that group won the deal, and he called me about a couple days later to partner with him on the deal. And I said, send me your underwriting. Let me take a look at it. And they're underwriting. And this is right when COVID hit. They were underwriting at a 3% rent growth. They were underwriting everything off of the T1. And I'm like, whoa, holy cow. I mean, how are you guys? There's no way. I mean, that's just way too aggressive. You're underwriting everything off T1. Well, we're going to close in 3 months, and it's going to be. I'm like, no, like that's just crazy. So at our 14.4, we were at like a 13.7% IRR, which is good for the market, and it's still a great return. But they were projecting at a 15 million purchase price, a 16.1% IRR, and I'm like, yeah. Holy cow, like that is crazy.
Do you find that, I mean, like the guys, when you are acquiring deals, I mean, what is typically, who are you buying it from, and what was it mismanagement, or, like the occupancy isn't where it needs to be? Like, what's the typical sort of, what are you finding when you're buying, what is sort of the reason, or the seller, where did they leave sort of money on the table at?
Yeah, it can be anywhere from renovations, little tiny renovations on the inside. It can be anywhere from, adding the partnership that we have with the Wi-Fi services, which is tremendous value. If they don't have interior washer and dryer, adding interior washer and dryer and charging for that. If the competitors can do it, and you can get that, go for it. Little things like that really add tremendous value in the multifamily business. That's why I love it, is because those little in price increases on a per unit basis add so much value to the overall property. So we look at that, and definitely management. We find a lot of our properties we look at, there's being poorly managed, laziness, which I have zero tolerance for. So that's what we really find. A lot of the operators a lot of operators I come across that we purchase assets from don't actually live in the Carolinas. They live in New York or somewhere else, and that helps tremendously because they're not familiar with this market. They don't, they're not too familiar with what's going on. So it helps tremendously on taking advantage of us being boots on the ground and local to the Carolinas to really make sure we're making the right decisions. Yeah,
that makes a lot of sense. So what is, if you don't have any, that's fine. But have you had or witnessed any sort of major implosions, just deals gone south where, an operator, or maybe one of the deals you did early on, or is there something where it's just someone completely swung and missed, or did a bad deal? Any gruesome stories you can tell about stuff you've seen?
Yeah, I mean, I've heard of some, knock on wood, we have not had any so far, but I've heard of some operators, especially during COVID, and some well-known operators, pushing, instead of their monthly distributions, they're doing quarterly now due to COVID, and they're having a tremendous occupancy issue and collections issue, going from anywhere from 90% all the way down to low 70s. So I'm seeing that and hearing that across the board, is occupancy issues on those type of type of properties, and collection issues. So I'm seeing that and hearing that across the board, but not, knock on wood again, no stories from my end when it comes to any bad deals. But hopefully we'll be ready once they come.
Yeah, that's just it. It's when you do see some of these deals get done at, like you said, they overpay and whatever. I mean, at some point, that asset's going to be back on the market, and especially for those that were acquired, just before the whole pandemic hit. A lot of those deals were really, it was really overheated, and at some point, I mean, you're starting to see that, especially some of these things roll off, like you said. I mean, some of these tenants and the Class C stuff or whatever, even the Class A stuff, as you mentioned, who just, they can't afford that rent and the occupancy, and they overpaid for it, and their debt.
Oh, yeah.
It's going to be really interesting to see, how this stuff shakes out. It's fascinating.
I agree.
But yeah, I mean, it's, as always in real estate, right? It's what's funny. I have these conversations with guys like yourself, and it's interesting, it over and over and over again, it just comes up, like, it just requires discipline.
Yes.
right? Like you just have to be disciplined, and and it just does. It comes down to like the local thing, knowing your market, understand what you're getting into. It's not one thing. There's not some, no one's got a magic wand. It's basically well-located assets that are priced right, with reasonable expectations. It's long game sort of mentality. And this is why I do this. Like I think that's just it, right? Like it's allowing, especially passive investors, those who want to get in. I mean, it's such a great investment. I mean, like, the volatility in real estate compared to the stock market and things like that, it's just, you can actually sleep well at night, but you just need to understand that, it requires someone who does know what they're doing, who is methodical, who is disciplined, who's operating in markets that, that are stable and those sorts of things. But yeah, when you get aggressive and you start overpaying for stuff, and and the more that goes on, or just that's how you get in trouble. And
I agree. And there was deals that I loved. I mean, I loved them. The beautiful, great markets. I fell in love with them. But the numbers didn't make sense. And when we got down to best and final, other groups were willing to pay a lot more than we were. And I'm sorry, tell the broker, look, this is where we're at. It's all about a numbers game to us. If numbers don't make sense, we're not going any higher. So if you can't make this work, then on to the next.
Yep. And that is, it's that it takes that patience, because that means that, it's transaction's not going to get done. But some of these guys who, it's a double-edged sword, right? If you see guys that are just winning deals right and left and just buying stuff right and left, I mean, sometimes it looks like, man, they must have the Midas touch. It's not to say they don't. And I think that's just it, right? Like, I don't want to, for me, it's like, there's no reason to pass judgment, but it's about, you need to, especially as a passive investor, you need to do your analysis. Okay, do I understand how the sponsor operates? Do I understand what they can bring to the table? Do I understand the market that's, the investments, in? And then do I understand the asset? Do I understand what's going on?
I'm actually finishing writing a book to help new passive investors understand and actually vet operators and GP teams, because it's important. I know a local group here, they're buying, they bought like 6 properties last year. They bought like, I think 5 this year. Like, they're killing it. And on paper, everyone's like, yeah. But I'm hearing from the inside now, their underwriting was way too aggressive, and they're coming out of their own pockets to make distributions and things like that, and to cover expenses. It's just very important to be careful and know who I always like to say it's a relationship. You're marrying that individual. So know who you're marrying.
Yeah, there's no doubt about it. No doubt about it. Well, cool. Well, it's great having you on, Chris. And we're recording this just before before Christmas. So, Merry Christmas to you and your family. And
thank you so much.
Have a wonderful holiday. And
yes, you as well.
Yeah, we'll be in touch.